busy week in the local data front with second quarter growth numbers, consumer and producer inflation numbers as well. Here to dissect all this is Mike Schussler from economist.co.za. Mike, thanks for coming in today. And perhaps let's just start with that strike action, because any decisions that might be taken on the back of this data will also have to take into account the ongoing strike in the country.
Absolutely. We've already got the wage increase in the public sector being 7%. The government says if you take in the housing allowance, it's about 8.6% for the top end worker and over 12% for the bottom end worker. So that's already a very high increase that the government is going to give through to the public services sector. And the fact of the matter is, public servants, civil servants are really not underpaid anymore. We've got a situation where they take home 28% of all formal sector wages, although they only make up 21% of all formal sector employees. So they take home more than their fair share. So the private sector really is not able to pay what the state is paying at the moment. And that also means that a lot of our revenue, apparently up to 46% of the taxes in this country, go just to paying civil servants' wages. That means there's very little money left in the kitty to actually do the services at the other end. And I can understand the frustration of certain people, but I think at the end of the day, we really got a situation where we've got to distinguish between people who actually are productive and people who are not productive. And I'm not sure if the state can do that.
Well, even with the government's offer that's on the table at this stage, it hasn't all been budgeted for. It's going to push our deficits a little bit higher, or we're going to have to cut spending somewhere else. What would it do if they had to pay the full amount that is being requested?
Well, if they had to pay the full amount, it would add about 6.3 billion. That's if we assume about 40% of the people would take a housing subsidy, because not everybody does that. But the fact of the matter is, let's put it this way, the government has said to us basically, the average teacher after 1 year's work gets 17,500 Rand a month for 13 months of the year. Now, that means that there's a bonus month as well. So we're already looking at a relatively good pay for somebody with some. The problem comes in with the progression, I would think. The other thing that I think the problem comes in with, right at the bottom, we're paying people 5,000 Rand a month to sweep floors. Now, this is something that people must start realizing, is that you cannot afford to pay somebody 5,000 Rand a month to sweep floors. Otherwise, you have to pay economists 40 billion Rand a day just to talk on a TV show, and then nobody can afford economists. So we can't afford the sweepers at 5,000 Rand, and we wouldn't be able to afford the 40 billion Rand economist either then.
Well, thank goodness we don't have that scenario, so you could come into the studio today, Mike. I mean, just looking at the impact of these wage settlements, if and when they do happen, on inflation going forward, because we had some particularly benign inflation readings this week. I think CPI at 3.7%, PPI edging downwards 7.7%, so looking pretty good on that front.
Yes, I was very surprised about the inflation numbers. I must say the CPI surprised so much on the downside, I really struggle to believe it. But I think let's accept that it's true, and let's accept that this is where we are right now. Let's also accept that the PPI is coming down. The one thing that we do know is that for the next month or two, the PPI will remain in the single digits, but towards the end of the year, it seems very likely that the PPI at least goes back into double figures. But there is a problem here, and that's the other part of the data, and that's the GDP data. And if you analyze the GDP data, it shows you that the deflator for the whole of the economy, with other words, inflation not for consumers, but the whole economy, is 7%. So there's quite a difference between that and the 3.7 that we're getting from the consumer price index. I'm sure the Reserve Bank is now more likely to cut than not, but I also think that there's a warning sign that there is still inflation out there, and that the CPI is measuring a certain basket of inflation, which at this moment in time looks to be heading down.
What do you see as the risk to the CPI going forward from here, apart from those wage increases?
Well, certainly I think if we look internationally, we've seen wheat prices move up because of the Russian drought situation. We certainly think that therefore in the main food prices were very benign, and they're more likely to go up now than would otherwise be the case. There's a big risk on the Rand side of things because at some stage we have to see a Rand weakening to keep us in contention. But at the moment, obviously, the Rand is very strong because a lot of people investors, short-term investors and longer-term, like the HSBC deal, are interested in putting their money in this country, either buying our firms or buying bonds and equity in the short term. And that's a very good inflow that's keeping the rand strong. But I think the risk is that the rand from here weakens.
Do you think that investors watching those strike picks, reading stories in the paper about what's happening in the mining industry, are going to keep sending short-term money into this country?
I think the short-term money is not under threat. I think where the threat is coming in is on the longer-term side, because we really have failed to attract long-term investments. Yes, a bit in our banking industry, yes, a bit in the mining industry, but we haven't attracted greenfield investments that transfers technology, gives us jobs, because people say, I'm not interested in trying that risk in a country such as South Africa at the moment. I'd rather do that in the China and the Indias of the world, where the potential return is so much higher and the risk of things like strikes is so much lower. And I think that's the message that we must put out there, that those are the microeconomic factors that we must address through the Department of Trade and Industry, for example.
You mentioned PPI, 7.7% at this stage. You said it's probably going to trend sideways for a few months. Double figures by the year end. Why?
Well, what we basically have seen, we've come from a very low base, we've turned around, and there are big increases in the PPI. We must remember the electricity counts 7% of the PPI and only less than 2% on the CPI side. Plus, the consumer price increases of electricity were a little bit lower than the price increases that the industry received for electricity. That's just one example. There are other examples of cost pressures coming through from the food side, especially the fresh food side, that will start gearing up as we head towards the end of the year. And I think that combination is probably going to push things up. Plus, at this moment in time, a broad range of commodity prices have stayed reasonably high in price. And that's coming through despite the strong rand. And one can argue that despite the strong rand, you're still close to 8% on your producer price inflation. Says to me that we've got a very big hole in our current account coming, because how the hell do we compete when our trading partners have got a PPI roughly of about 3%?
Of course, we had the Finance Minister, Praveen Gordhan, speaking yesterday and saying all the factors that the MPC would have to consider, such as the benign inflation, the growth outlook at this stage, and also the monetary support that the economy might need. Do we need further support?
That's a very difficult question to answer. I'll tell you why. The other day I sat here and I criticized the banks, and I still will criticize the banks. I think the banks haven't opened their pockets right now. And I'm not sure if lowering the interest rates is going to make a difference with that. I think what banks are worried about, they're worried about a certain other amount of risks. They know that there are many consumers who are overextended in the economy. With the National Credit Act, it makes them liable for it. Second of all, the growth in the economy and the growth in exports is not as sure as it seemed before, and banks are a lot more risk averse worldwide. That's the situation. So to lower your interest rates another 0.5% will affect the people that are currently in debt, and that will lower their cost. So the problem is that there is a quid pro quo on the savings side, where those people are going to pull back on their spending as well. So I think on the balance of risks, we'll probably see interest rates come down. What sort of difference it's going to make? I think very little, Stephen.
Of course, we had one of the deputy directors of the Stats SA yesterday saying he expects growth this year to come in at 2.3%. And that's quite a bit lower than Treasury, the South African Reserve Bank, and many economists are expecting. They're expecting growth of about 3%. Do you think he could be closer to the mark?
No, I myself am at 3%, but I think the point of the matter that we need to make is this year we're growing. Last year we declined, and the growth this year will make up for the decline of last year. But the bigger issue here is, if we did grow at 5%, would we be able to handle it? Right now we can't. We don't have the skill sets in this country, and also, as importantly, we don't have the electricity. In some areas, apparently, we don't even have the water. Especially in rural areas. So certainly South Africa at the moment has a lot of growth constraints. And that's why one wonders this week as well, when President Zuma makes comments about 7% growth is what we want to aim for in the short term. That's just not possible. And at 7% growth, we will have inflation of double that number. And what worries me is that there is signs, as I said, in the GDP numbers that there is a higher rate of inflation out there that people must be aware of. There's a 7% GDP deflator, and that's virtually twice the rate of our current consumer prices, which says to me somewhere else in our economy there must be an inflation of roughly 10, 11% out there to make that GDP deflator at that sort of level. And that is a concern on our growth side that we would have for the next 2-3 years until we've got at least the electricity sorted out. Then we've got to sort out some of the other bottlenecks in the economy.
Of course, there have been lots of calls for the rand to be weakened significantly to help boost that growth by making our exports more competitive and the likes. But of course, that would also again feed into those inflationary concerns, wouldn't it?
Yes, and the other thing about the rand is it would create perhaps a survival mode for some companies that are in there, and it'd give them a bit of breathing space. But what we've got to realize is that one of the things why the consumers are buying certain things is because those prices for the consumers have lowered, and that's clothing, for example, and hi-fis and TVs and so on. They've sold very well. Those prices have come down tremendously, and the consumers have picked up on that. But just saying this very quickly, on the, I'm not sure how much extra exports we're going to get if we have a lower rand, because 70% of our exports are commodities. We're price takers, and that's not going to make a very big difference on that side. On the manufacturing side, here and there, it could make a difference, but I think it's going to hit all of the consumers, and I think that's something that we need to weigh up when we do talk about a lower rand.